I will start the session by sharing a news from Wall Street Journal because I think last week everyone was busy talking about like all these SVB Bank, Silicon Valley banks and the Silvergate and so on, right? So now I think this week we'll talk about Credit Suisse because this is there's something going on during the weekend, and I think something will come up by tomorrow. So actually, this is the headline: UBS near deal to take over Credit Suisse. Discussion are part of urgent effort by Swiss and global authorities to restore trust in banking system. So I'll just walk through the article and mention a couple of important points. So the news say that UBS Group is nearing a deal to take over Credit Suisse Group, part of an urgent effort engineered by the Swiss and global authorities to restore trust in the banking system. The deal could come together Sunday, if not sooner. I think this one, the interesting part is that it's not like Credit Suisse they want to sell and UBS wanted to buy. Actually, this whole thing, right, is like engineered by Swiss National Bank, which is the central bank of Switzerland. And they really kind of like force the buyer to buy and cause the seller to sell. So that's the interesting part. And if you look at the market cap of these two companies, actually they are not too far away. Let's say we're talking about like 2019, 2020. But it's just that in the recent 1 or 2 years, there's plenty of all these scandals. And then Credit Suisse, from the surface, it looks like they really did all the wrong things. I think there's this whole long list of scandal. I won't go through that. Some spying and so on, right? So that was quite interesting. If you go and do some YouTube search, you can definitely watch some YouTube there. The urgency on the part of the regulators was prompted by increasingly dire outlook at Credit Suisse. So the bank faced as much as 10 billion in outflow a day last week, and it will become insolvent next week if not dealt with. So actually, I don't know if it's that serious because I thought that their problem is always on the investment banking side. But apparently, I think they also face a lot of all these outflows. So as you know, for banks, if you keep facing outflows, first you have liquidity problems. Then after that, once you run out of deposits and you need to go to interbank or you need to get some financing from other sources, people will look at your credit quality and if there's some doubt whether Credit Suisse is able to honor all this, like pay off their debt, right? People might not extend the credit to Credit Suisse, so that will be insolvency problems. So that's why I think they're really having a huge crisis as of now. The bank have discussed a number of scenarios, including those that end with UBS taking over all or parts of Credit Suisse. So they're talking about like whether to break down, because Credit Suisse, I think they still have investment banking and their retail banking. So I think for the acquirers, even if they don't like the investment banking, just the retail banking itself will worth some money. It's not like near like current market cap. So you can think of it like the retail banking part probably worth like, let's say, tens of millions. But the investment banking side, maybe because of the shortfall of their asset versus liability and all this, that in terms of their reputation also not so good already. So maybe that part is the part that drag down the valuation of the company. Just to give some idea of the size, right? So UBS, their asset size is 1.1 trillion. And according to this article, Credit Suisse assets is about like half of UBS. So probably around, like 500 plus billions. Any full-scale takeover will give UBS price business within Credit Suisse, such as wealth management clients in Asia and the Middle East, but might come with less desirable units such as Credit Suisse troubled investment banks. So the market cap of UBS is 65 versus 8 billions for Credit Suisse. This is their size. Yeah, this one talking about the local retail bank could on its own worth 10 billions, but the investment banking side is the question mark. And in terms of their number of employees, Credit Suisse has around 50,000 employees. UBS about 74,000 employees. So you look at their employees size, right? It's not that different. It's only like 50% higher. In terms of assets, also like 2x higher. But when you look at their market cap, it's like 8 times higher. So it just means that Credit Suisse currently their valuation is really priced at that, implying that they will go through some sort of restructuring or bought over by another companies. Because once you bought over by another companies, meaning that whoever bought Credit Suisse shares, let's say like 1 or 2 years ago, they will be like diluted or will be like become a permanent loss because apparently they will have to transfer that ownership to another banks at like current suppress price now. Any combinations likely would result in substantial job losses beyond the more than 9,000 positions Credit Suisse already had promised to eliminate as part of their turnaround plan. So this one, I think I noticed this article before this. They say they are going to downsize their investment banking business. So apparently 9,000 positions will be eliminated. And now there will be more to go up, because once you have M&A, you don't need all these duplicated functions, right? So you can just shrink the size, and with that lower their expenses now. But the thing is, between these two, I think one issue is that once you combine two very large banks, there's antitrust issue, and basically they have to weigh the pro and cons. So antitrust means that now you have one big giant banks that actually they basically like command big market shares. It's really not good from consumer perspective. But if you don't do anything and let the bank just fail, I think that's also a huge problem, because there might be some escalations, right? It might cause problem on other banks, on other the ripple effects will affect other companies as well. So this is what the regulators is worried about now. Then nothing much here. I think here say that Swiss authorities are expected to reach at least a rough deal before Monday market open. So we can wait to see another 24 hours. And this one is quite interesting also. You could look at their total assets, right? Credit Suisse already shrink quite a fair bit compared to 2 years ago, whereas UBS is doing okay. And I think there's another chart that shows their profits. So I think this is the one. The net income, you can see that UBS is still going strong, right? But for Credit Suisse, they have like huge losses in 2021 and 2022. So just shows that they have a lot of problems. And now they already have reached a problem that there's no turning back anymore, because they are actually subject to other investment banks financing. So if other banks, right, they just say, okay, the problem is too big, I can't let it continue anymore. So I don't want to extend all this financing. They will just let Credit Suisse go, right? So if that happens, really, it will be in bankruptcy situations. So this is what is happening right now. And I think for the regulators, they just want to engineer something so that they can alleviate the pressures on the entire banking sectors. So I think that's all. I think it's just a very interesting article, and all this is happening very fast, right? Like last weekend, we saw that Silicon Valley banks, all this problem, and then basically all the regulators, the boards of the banks, they're all having discussion during the weekend, and we can see that just right on Monday, like our time is Monday morning. So all these measures came up just to address the issue, and whatever crisis or trust issue on the banking sector, all this is not done yet, right? So I think by tomorrow they have to announce something. If not, I think this entire thing will keep on drag on, and the longer it drag on, the more issue it will cause. People will start to draw their money out from the banks. So I think that can have a cascading effects. So that's why they really have to move fast. But quite a sad thing, I think, for old banks, Credit Suisse. Although, I mean, recently their reputation isn't that good, right? But still, very old banks. They have all those history. But once you have encountered this kind of situations, the name will just disappear. That just become another Lehman Brothers, right? So I think, how to say, it's just a sad thing. You look at old institutions just gone like this. I don't know. But it's also telling other banks that, okay, if you don't manage your risk properly, what happens is that you will just go under, and I mean, the worth of the company can just go to zero. I think this is also something that I think other banks will take it as a learnings and don't do stupid things. Okay, I'll just stop here on this. Let's go to Slido, and JD should buy US or Hong Kong, because dividend for China company, how it differs for US listed or Hong Kong listed. I think on these questions, right, in terms of total return, it is the same whether you own US ADRs or you own HK stocks. I think when it comes to total returns means that the price plus the dividends. So they are the same. If it is different, then it will be an arbitrage situation, right? So maybe that one, just to set that first. Then secondary is that what are the differences between these two, right? And why would you want to choose one versus the other? So there are still some differences. Say for example, like JD US, they are traded in US dollar, and Hong Kong one is traded in Hong Kong dollars. So depending on your preference, you might want to trade in certain currency. So I think this is the obvious difference. Other than this will be like, because if you trade in US market, I think the fee will be different as well compared to Hong Kong. Usually, I think Hong Kong one will be more expensive. So please take note on that now. So you might need to trade at a larger trade size in order to make sense of the fee. So I think fee is also something that you should look at. What else? There's another one, which is the lot size. I think for Hong Kong one, their lot size is 50. So you have to trade in a multiple of 50 shares. And if you just convert that back to US dollar, right, I think it's about 1,000 US dollar for 50 shares of JD, the Hong Kong one. So if you compare that against US, US one is some brokerage offer like fractional trading and so on. So it's just a lot more flexible for you to trade in US. So I think other than this will be trading hours. So if you prefer to watch the price like ticking during nighttime, then you might want to trade the US one. But if you watch all this market during daytime, then maybe Hong Kong one is the one to go. So I think these are the differences that you can consider. But when it comes to dividend, I actually don't know a lot. I believe, let's say if you own US one, there should be some withholding tax for the dividends. But I'm not 100% sure about the treatment for ADRs. I believe they might be some. So, but this one I'm not too sure. Boon Song, I don't know, you know about the withholding tax for like, for example, like buying Alibaba ADRs?
In the past, when I had GSK, right, I think the dividend withholding is based on the company domicile, the place where it's domicile at. So I don't think this is a concern if you are after it for the dividends.
So you mean they don't need to pay the 30% on dividend?
I don't think they need to.
Okay. This one, I sense that Boon Song and myself also not too sure. Maybe you can just fact check on this. But I would say that the dividends maybe is a smaller issues compared to the one that I listed, like the currency, the fee, the lot size. All these are, more like in terms of operations, right? In terms of how you execute the things, will play a lot more importance as compared to the dividends. And by dividends, I think usually it's the tax that is different, right? Because if you own the shares, I believe whether it's ADR or not, I believe you should still get the dividends. So still same dividend, it's just the withholding tax is different. Could be different. Not saying they are different. Okay, let's move to the next one. Let's say I wanted to start reading BIDU 10K. Do you read from 2021 and go backward, or you read from the start, which may be 10, 15 years and read forward? First thing I want to say is that I don't think Baidu has 10K. I think 10K is only US companies. Baidu is clearly China companies, and they just have an ADR on US exchange. So there's no 10K. You can anyway read their annual reports. So that one you can do. But whether you want to read from, from early years to the most recent years or go backward, I think it's really up to your preference. I would suggest maybe don't start with the annual report first, because I think annual reports, right, or 10K, right, actually they are very dry. And there are like so many pages that if you just started reading, right, you feel a bit lost, like don't know what to look for. I think the right sequence is that you try to read, say, for example, like 2 years of the earnings call transcript. So assuming like, let's say four calls per year, right? So you just read like 8 quarters. So when you read that, you can have a sense of what are the questions that all those analysts ask. And usually these are the questions, or these are the things that actually drive whatever that's important to the analyst. Say, for example, like you read about like C Limited, then they might ask about the growth. They might ask about, for example, their gaming business. They might ask about their India business, all these things, right? After that, once you know what are the questions that people ask, because they only ask questions, and even the answer also, usually they tend to be like on the surface. They don't go into very details, and just reading the answer, you don't have a sense on like what are the real numbers. And when you go through the 10K or like all these like all the disclosure of financials, you can you can actually like put all those numbers into the spreadsheet, and then you can look at the numbers yourself and see how it tracks from quarter to quarters. And because you already know what questions people wanted to know, you know the questions first. And when you read the 10K, it's more like finding answer to the questions. So it will be easier, and because you already have questions, so you're easier to digest. Say, for example, for myself, when I read like TSMC 10K, or it's not 10K, again, it's their annual report. When I read their annual report, I don't go like pages by pages and line by line. To me, that one is like not doable. It's just too dry, too boring. But I'm interested, say, for example, like, okay, usually how long would they take from introducing, let's say, 5 nanometer until they ramp up to a decent size in terms of their revenues? I don't know that, right? But if I read the all those earning transcript, they talk about all this, like, okay, we give an update, now our 3 nanometer just started and so on. They give this kind of update, so I know these are the important stuff, right? So when I go to the financial statement, what I do is that I plot like, okay, 5 nanometer, I look for the table, I put that into the spreadsheet, then I can track, I can plot some chart to see, okay, so these are the distribution of their different process nodes. Then I track across time, then I will have an idea. But it's more like I use the annual report to look for the answer. Because if you just read without having a questions in your mind, right, it's very dry. And once you do like if I just want to look for specific indicators, in the example I just given, right? I just want to know like the 7 nanometer, how long will it take to ramp up? The 5 nanometer, how long will it take to ramp up? Basically, for each year, I only look for one answer, right? So I'll just open like 10 years of their annual report and just extract one piece of information and just do it slowly and just digest. And then if around that annual reports, I read what are the stuff that they discuss about on only on that sections, right? So even if you read 10 years for a specific questions or specific item, it isn't that taxing. But if you imagine like each annual report is 200 pages, you read one report, it's only how many hours spent, and you don't even know what to look for, right? It's very dry. You might actually, you thought about, okay, let's start from 2015. Actually, you just start at 2015. You can't get past 2016 because it's just how dry it is, So I would say, first, understand what is important for that specific company. Then you know what to look for. Then you go and track all these annual reports and just look for the items that you are interested. And then once you are okay with that specific questions, then you are fine already, right? Maybe then you can go to the other questions that you want to know. Like, say, for example, talking about Alibaba, sometimes we talk about, okay, their retail, or how much actually they invest in those like special projects that keep on burning money. Are they really keep on burning cash and so on? So these are the interesting questions that you first draw out the question first. Then second, then only you go and search all these reports and go and find answer. So doing that will make like the research process a lot more interesting. But I would say that all this really takes time. When you go to do all this like primary research, you don't read other people's research, right? You do it yourself, right? One thing good is that you do it very slowly. You really take the time to don't rush it, and just take the time to absorb and just read. When you read, it's not just like pick one information, then move to the next one. When you pick one information, also there's some word around, you go and read, and I think all those help with your understanding on the business. You have anything to add, Boon Song?
My process is also the same as you. I will go through the numbers first, and then if I find something very unusual with the numbers, I will also look at the report for that year.
Yeah, I think that's the interesting. Usually you see some unusual things, some one-off things, and you want to understand what are those things. You have to read the explanations. So I think that one also help also with the research. And you will uncover all those like small things that people don't talk about. Because if you just read the news, I think news, they have a lot of things that just talk on the surface only.
But actually, if I to look at the way of looking at spreadsheets, the numbers over the years, and then going to a particular year to read the report, there's also a potential pitfall in that. When let's say during COVID, right, you expect the numbers to be weak, and then maybe you omit looking at that year's AR, and that could be a pitfall. Maybe it's also good to be more inquisitive and read everything.
Yeah.
That's my take.
Okay, next one. Among all Chinese tech, Alibaba, Tencent, JD, Baidu, Meituan, PDD, do you think Baba is the worst, or at least still growing? Only Baba a lot of excuse not growing. Boon, your comment.
I think Baba is on the premise of being value. When it comes to some of the parts, it seems to be possibly undervalued. That is the play for most people when they buy Baba. But for the rest, the ones that you mentioned, like Tencent, I think in terms of valuation, is not so glaringly cheap. Although it does have a lot of perceived valuable investments. JD is probably about growth. I got no comment. Baidu could be difficult bet. Meituan also a difficult bet. Obviously, you know yourself. You had Meituan at one point. No comments about Pinduoduo. So I think maybe it's more of a case of them being different kind of bets.
Not one point of time. I still holding it. Okay, I think on this, right, I would say that for China, maybe first we need to split out those that is not competing with each other. Actually, the one that is like strongly competing with each other is on the e-commerce. Because if you look at e-commerce, right, Alibaba, JD, and Pinduoduo, these are in one big same category. Tencent, they are more on social media and also gaming, so they are kind of like different. Baidu is more on their like autonomous driving, AI stuff. So Baidu also quite very different from the pack. Meituan is more on food delivery and then all these what they call the online offline services business. So like all the hotel, food delivery and so on. So Meituan are also slightly different, but all these they have some small overlap now. So I would say if you prefer certain, say for example, if you prefer food delivery, then you just go for Meituan. I think that's more targeted kind of investment. And same for like Baidu and so on, right? But comes to e-commerce, I would say that e-commerce, if you look at macro level, I think China is still growing. Alibaba, they are so big because of the first mover advantage. That's their starting point. And even until now, they are still very dominant, despite that all the other competitors like JD, Pinduoduo, they keep on like as if capital is free. They just keep on burning capital to grow their business. So if you track their market share, I would say that by JD and Pinduoduo, I think just based on my sense, I didn't follow this very, very closely, but just based on my understanding is that JD, Pinduoduo, they really grow and focus on growth. So they take on the market shares from Alibaba. And Alibaba, because they are already dominant, I think it doesn't make sense for them to like burn. Because if Alibaba burn capital, don't care about profitability, and everyone do the same, right? It will be like everyone just keep on burning capital, no one get profitable, right? So Alibaba, their stand is that they leverage on their scale. They just keep on doing what they are doing. And when others are burning a lot, they don't follow as much. That's why they are still profitable because of that. It's a lot easier to burn and keep market shares. And if they are doing that, it hurts on their profitability, but they get to, like kill off their competitors, which is not something that is healthy for the investor and not something that regulators like to see, because it's not a long-term viable way if everyone just compete like that, right? So Alibaba, they do less cash burning, hence they are a lot more profitable. And if you look at their free cash flow, all these are still generating a lot of cash, and they have a lot of money sitting with the company that they are not utilizing for cash, not for share buyback, and they aren't distributing dividends either. So I think that's why it become like a super cheap, like what Boon just mentioned, right? It become like a value picks, because if you look at their PE, you might want to, deduct the cash holding that they have from the market cap, because essentially if you buy the shares of the company, actually you own all this cash, So I think that's the good part about investing in Alibaba. But whether they are growing or not, this is like you need to understand the entire landscape, because it's a lot harder for them to grow when their competitors doesn't really care about profitability and they care more about market share. So it's a bit harder for them to compete on and to increase their market shares. One is because of their dominant scale. Their market share is already very big now. That's one reason. Second reason is that competitors is just going crazy. So I think just understand the landscape, and if you're not comfortable seeing let's say seeing Alibaba need to compete with JD and Pinduoduo, which is doing crazy things, right? You don't like the competition because sometimes competitions isn't that good, because there's competition, there's price pressure to bring down the price. That means there is a downward pressure in terms of their profitability, right? So if you don't like seeing these things, I would say just avoid the e-commerce, or maybe like just avoid it. Because if you invest in Alibaba, you have to be comfortable with this. You need to be okay with this kind of situation. Yeah, that's what I would say. But in terms of growth, I won't say it's because the management can't execute, hence they can't grow. I will blame this to more on the macro side and on the competitions. So that's my take. How is the Chinese autos like NIO, XP, XPeng, Li Autos, and as compared to Tesla, will they catch up with Tesla? This one I think Winston also no comment, so I'll comment. I think as of now, if you look at this NIO, XP, Li, and even let's include BYD here, right? If you just look at Chinese market, they are like very clear segment. So on the premium segment, I think Tesla is still having a very healthy market share. So they're still quite dominant. But in the secondary tier, right, like not the premium, right? So I think BYD is like clearly they took over a lot of market shares, and Tesla don't really have any market share and at those like cheaper tier. So Tesla is not even there. So it become a competition between all these different names. I won't say it's just NIO, XPeng, Li. I think there are quite a number of EVs that offer cheaper price together with BYD. They really dominate the entire EV sectors in China. So at least that's the market share in China. But if you move up from China, you just look at global market shares. I'll say that Tesla is still very dominant in terms of the market share. I wouldn't say it's because like their product is like super good and so on. That's why they are winning. I will attribute this to the first mover advantage, because Tesla, they started this entire EV industry. And when someone want to buy an EV, I think the one thing they look at is their the charging network. And for Tesla, their charging network is just like much better compared to the rest, right? So this one, you don't really need like a superior car. Just the charging network itself is a boost to the buying decisions on picking Tesla as your choice when you want to go for the EV, right? So I think if you look at the entire global and just want to understand their competitiveness, I think Tesla is still there just because of all this like first mover advantage. Then next, let's talk about their product. I think product-wise, they are actually quite, how to say, it's not like super different compared one to the other. Say, for example, if you look at their battery feature and their spec, actually, if you compare Tesla versus, let's say, BYD, in fact, Tesla, I think they also source their battery from BYD. It just means that if you talk about battery, actually, BYD is just better than Tesla. Tesla sourcing from some other supplier as well, for example, like Panasonic and so on. I think they are quite competitive. It's not clear that which battery is better. So if you say Tesla battery better than BYD, I think that's just like plain wrong, right? Because BYD, they are in battery business for like longer. They supply to others. They have the scale. They have the cost advantage and so on. So I would say that when it comes to battery, BYD is just better, right? And when you talk about like all this autonomous driving and so on, this is like long debate that we have in the past. I think the conclusion is that Tesla is having very different approach when it comes to their autonomous driving. They use a pure vision approach. But when it comes to the capability, I think it's just still lag behind those autonomous driving that use LiDAR. So I think that's the facts, right? So if you say Tesla is, when it comes to autonomous driving, is better than AutoX, BIDU, and so on, again, that's just plain wrong, right? Because the others is really better than Tesla. It's just that Tesla using pure visions only, if they can get it work, it's just a much more scalable solution as compared to LiDAR and geofencing and so on. So depending on how you look at it, if you talk about like scalability, I think Tesla approach is the better one. But looking at their current capability, it's just like not as good. So you need to have an objective view on this capability. Aside from battery and all these others, I think Tesla have some advantage when it comes to manufacturing, because I don't feel that other manufacturers, they focus so much on the manufacturing side. Say, for example, you can see other automakers similar to Boston Dynamics robot versus Tesla robot. So on surface, right, you compare the Tesla bot, right, it's really very bad. Like, wow, how come you design a robot that can't even walk properly, right? So they are very bad on the surface. But why is it like so bad, right? It's because when they designed the robot, they didn't design from a perspective that I want to make the best robot. That's not their starting point. They started out from the starting points to say that how can I manufacture this robot at scale at a very cheap price so that I can really like churn up a huge number of robots once this robot start production. So they started up from manufacturing. So if you listen to the investor day when Tesla give their like presentations, you can see that a lot of focus is on the manufacturing. How can they manufacture cheaply in a better way and so on. So I think this one is very important now, because once you think from manufacturing perspective, there are ways for you to like reduce the cost, make the manufacturing a lot more efficient, and all these cheaper costs really leads to like low cost mode. So if you believe they are doing that and they are successful in that, I think in terms of growth, there's no problem for Tesla to continue to grow. But when you talk about like what is their current product, I think this one still debatable on which one is better. I don't think like Neo, XP, BYD, they are, in terms of the product currently, I don't think their product is like not as good as Tesla. You just do a comparison, maybe do a test drive, and you can come to the conclusions. Pause here a second, see anyone want to debate me on this. Okay, next one. Putty can advise more on your trust bank recommendation and when is deadline. Seems like UOB, local banks, too much business, give them a chance. What's your thinking? First, I won't say I recommend trust bank. To me, trust bank is just a bank account, online bank account. So the reason I send out the referral code is because I think they just increase the how much, how to say, the referral fee. I forgot how much already. Maybe it's like $20 or so. I forgot already. So if I refer you, you sign up, you get like, I think $10. I get like what, $10, something like that. So I was just thinking that, okay, all this like no much effort one, just share it on my Twitter. And for those who sign up using my code, yes, I get like what, $10 referral fee. If you don't sign up also, or you already sign up, that's fine with me also. So I think this one is just like referral, nothing much about their products. And in terms of their product also, I did use them for some time. I actually used it for Simply Go for my commute. So I think they are not different compared to other credit cards. I can't think of a way to justify like, okay, just sign up this one because their product is good or bad. I will just say that sign up process is very good. It's like very seamless, no much hiccup. So I'll give a plus on that. Other than that, just use it as a saving or like the card. I think it's not that different compared to other companies. Do you buy treasury bonds, usually IBKR? Can I know what is the minimum lot? Can you let us know the ticker at IBKR? For example, 6 months, 1 year treasury bills. Thanks. I'll say that on this, right? In terms of the how long it is, I think you can find like quite a number of different maturity, because for IBKR, for US Treasury, there are like 1 month, 3 months, 6 months, and there are quite a number of bonds. It's like they issue at 6 months. Now they are the remaining term is like 4 months or 2 months, right? So there are like plenty of maturity for you to choose. So I think you can choose the one that you like the most. That's the one. In terms of how to buy this one, I really can't help because I really haven't bought any treasury bonds from IBKR before. So I give you the reasons. Because if you buy treasury, US treasury bonds, actually the exposure that you have is the USD. So the risk that you are taking is not so much about the capital, because US treasury never bankrupt one. So don't worry on that. So there's zero credit risk there. You earn a risk-free rate. But the risk that you're taking is the USD. Say, for example, suddenly now all this banking crisis happening, right? If really a crisis continue, what happens is that suddenly US Fed, they can just drop the Fed fund rates, right? They can just cut rate, do QE and so on. If they really go into all this monetary easing, the interest rate drop, what happened is that US dollar will also drop. Because now if someone park money in US dollar, they just park in like all these US Treasury, they can still earn some good yield, right? If the yield is like cut by half, there's no point for them to expose to USD anymore. They would just like sell that USD and go buy some other currency. And you let's say if USD drop, then you have a huge devaluation. If you look at your portfolio from the perspective that your base is, let's say, Singapore or Malaysian ringgit or whatever currency, right? So you can still suffer a huge capital loss because of the currency. So I would say that if you buy bonds because you are not willing to take risk, and if you buy US Treasury anyway, you are taking FX risk, it doesn't make a lot of sense to buy US Treasury. I would say if you base in Singapore, better just put your money in, like, let's say, Singapore Treasury bond. Of course, your yield is slightly lower, but that's fine because actually, when it comes from risk perspective, you are taking a lot lower risk. But for some people, it makes sense to buy. For example, like, okay, you have money that anyway you don't plan to convert back to Singapore dollar, so you just want to have some, like cash buffer in USD. And maybe when the time is good, you want to use this USD cash to buy some USD stocks, right? Maybe in that sense, okay, you can buy that. Yeah, because you effectively you are taking USD as your base currency, so there's no risk if you see it from that perspective, lah. But in terms of how to buy minimum lot is, I think, it's very small. Don't worry on that. I think it's in like 4 digits, let's say thousands. So you can definitely buy that. It's not like those big lot size that you have to buy in 100,000. It's not like that. You can buy. It's very low. It's just that in terms of which ticker to buy, this one, if one day I figure out, I will share with you. Maybe you can just looking. Maybe you can ask this from time to time in the Telegram group. Someone may able to advise on this but for me, I haven't buy this before. So far, any signs of IBKR going bankrupt? How do we monitor IBKR financial health? Seems like SCHW suddenly can have problems, so all not safe. Let's go through the SCHW first. Charles Schwab. So I actually saw some article. I can share the article later in the group. Remind me if I forgot. But I think the SCHW, the situation is that they have a brokerage business and then they have a banking business. So what happens is that if you put your cash in the brokerage and if you don't utilize your cash, right, say for example it sit in the form of cash, they will actually sweep all this cash and they will put on the banking side. So if they put on the banking side, actually you get the 250k insurance. So I think if your cash is less than 250k, I don't think that is a problem. Okay, so no risk on that. But let's say if you put 1 million in the form of cash in there, I think you need to be concerned. So that's one. I think in terms of the custody, right? Say for example, if you bought some shares, I think also no problem because anyway, if you bought shares, those shares they have to put on their custodian. So if it is under a custodian, usually also no problem because the custodian, they have no other rules except for housing your shares, right? So it doesn't merge or mix up with the brokerage business. So even if the brokerage went down, right, the custodian still there, so your shares will still be around. So also don't have to worry much on that. But if you just look at Charles Schwab, really, I think they also suffer some same problem. I think it's the banking side. They also have similar problem as those faced by Silicon Valley Bank, which is that they own some long-dated bonds. If they own all these long-dated bonds, interest rate already went up. They have some fair value loss. Yes, they are facing this problem. And on their deposit side, if all this cash sitting with the brokerage that sit under the bank, right, and if the customer pull out their money, they also have problems because all this actually is like a low-cost financing for the business, right, on the banking side. If all this cash is withdrawn away, I think it also put their banking business at a very fragile situation. So I think that's why there's some problem with Charles Schwab. I'll stop there. In terms of interactive brokers, they are very risk averse when it comes to risk taking. So I'm not worried on that now. So I was just stop there. I haven't really went through their financials in detail. I can't say that they have no problem, but for myself, I put my money there. I'm not afraid because I kind of like I read something about interactive brokers. I know how they manage their business. So I'm not afraid that suddenly they will go under. Anyway, they also have their custodian, right? So all these shares with the custody, it's not going to go missing overnight. There are a lot of controls around. If there's a lot of interest, let me know on this to dig down their financials to understand how solid they are. But I mean, just understand their business model. I'm not afraid even putting few 100K with IBKR. Anything to add from Busong or anyone else? Netflix going to report 1Q23 earnings soon. 700 have not reported 4Q 2022. They so inefficient or need more time to cook the books. Something wrong with China, man. Wow, a bit mixed up here. So Netflix is US companies. So suddenly talk about Tencent. So I'm a bit confused on these questions. One thing I would say that it's not like they are reporting. I think in terms of when they report, right, you need to look at last year. Say, for example, like 4Q 2022, if last year they report in February, now suddenly until March they haven't report, then I think that one is quite concerning. But let's say if they consistently report, let's say end of March for certain quarter, as long as go as per their normal schedule, I would say don't be worried. It's just because of maybe their financial cutoff date and their norms. So, and anyway, they have all these regulation to say they have to report by how many days of their closing. So if they are not they haven't report like after the deadline, I think this one's definitely come up with in the news headline one. So I'll say that now. So don't come up with your own, like story to say that, because they are late and then they have problem. Sometimes it's just your brain coming up with some story that you want to freak yourself up. So don't do that. Anything to add from Busong?
Not really,
Okay.
but I'm very curious that they are two very different companies. not even thinking about the country that they are based on, but they are also two very different companies. Second thing that I like to add, despite the huge amount of mistrust in Chinese entities, we got to remember that the biggest scandal that we have over the history of investments, right? Most of them come from America. So we got to be fair to the Chinese.
Okay, I know why Netflix is put together. It's because this thing here, 1Q 2023. Netflix going to report 1Q 2023 and 700 not report 4Q 2022. This 1Q 2023, right? I think you need to be careful because different companies, they kind of like label all these financial quarters differently. I think one good example is Nvidia. If you go to look at Nvidia, their 1Q 2023 sometimes looks very funny one. There's a couple more companies that when you look at their how they name this, right, it's very funny one. So maybe don't pay too much attention to this. I usually don't look at this one. I'll just look at their balance sheet and look at the balance sheet cut-off date. What is the date? Because some companies you can still see like 1Q 2023, but you look into it, right? Sometimes their cut-off is not like December. It could be like end of January, end of April. So I think don't pay too much attention to the name. Pay attention to the cut-off date. So now I understand why they put together. It's just because like, they run until 1Q already, 700 haven't reported the 4Q. It's something like this. It's not talking about their business. Okay, next one. Why did Amazon not classify fulfillment costs under cost of goods sold? Also, why some AWS costs classified under tech and lump with R&D? AWS should go to cost of goods sold. Amazon cooking book. Wow, good question here. First, I would say it's not cooking book. If you call it cooking book, right, it's more like, suddenly they change this, they change that, and so on. That one, I will call it as a cooking book. If they consistently doing the same thing again and again, and if you follow their income statement, balance sheet, you have a sense of how they report their earnings. And if their reporting is in line with some, all these IFRS and so on. So I think that's fine. Again, don't like come up with your own narrative on company doing all this crazy thing. Usually they are not. Okay, so this is first statement. Next, let's talk about like why they do not classify fulfillment cost under cost of goods sold. I am not accountant. I never study accounting before. So take that first. So now when it comes to my own guesses on why they don't classify fulfillment costs under cost of goods sold. I think cost of goods sold, usually these are the costs that really directly you can tie it to the sales. Say for example, if they sell you a computer mouse, you buy the mouse, right? They sell you. They know how much is the cost because they bought the mouse in the first place. Then they sell to you. Okay. So this one definitely cost of goods sold is how much they bought the computer mouse. Say that you bought it at what, $20. They bought it at $15. So they profit $5, right? So cost of goods sold 15, then revenue 20. So they have a gross profit of $5. As simple as that, right? So that one is because they can really tag that $20. How much is the cost? That's the $15, right? They can tie it. So there's a definite answer there. But the fulfillment cost doesn't fall into here because fulfillment cost is not directly, you can assign it to the specific sales item. Fulfillment cost is more like, okay, they have a business going on. They need to build their all this fulfillment capacity, logistic network, and so on. These are more like, you know, like a one big cost that cover the entire business. So that's why they don't sit with the COGS. Say for example, like you set up a restaurant, then you sell what is the cost of goods sold, right? So you can say that all the materials, raw materials that you buy some vegetables, some meat, and then you cook it and sell to the customers. All this you can put it under cost of goods sold. But let's say the electricity, I don't think electricity they can put it there, right? Because whether you run your business, whether you got customer or not, you still need to pay for your electricity, right? So very hard to put electricity under the cost of goods sold, right? So this is like my layman way of understanding why certain items they can fall under cost of goods sold and some are not. Again, I'm not accounting trained, so someone, if you listen to what I just said now, you find some errors here, please correct me. But my layman understanding is that yes, if they can tie it to the revenues, then they will be in the cost of goods sold. If they cannot, meaning that let's say R&D cost, you do R&D already, it doesn't link directly to your sales. So they will put, they won't fall under cost of goods sold. R&D will not be in. The CAPEX, for example, like AW cost, right? The CAPEX and so on, they might lump in the tag, they might lump into R&D because it isn't clear that this will fall tagged to the revenue. If it can tag directly to the revenue, then they will be in a COGS now. So I think that's my sense. That is also why when you look at their income statement, sometimes their income statement, their profit is very hard to understand. It's because of this situation. Because let's say if they spend a lot in their logistic, right? They might actually, whether they are able to capitalize it or not. If they are able to capitalize it, it will not be in the, how to say, their expense, right? Basically, they can amortize it. So that's good from profit perspective. But let's say there's certain items, say for example, if they fall under R&D, you cannot capitalize it. Say for example, they spend 20 billions, they are in R&D, that if successful, it can come up with something that is they can sell to the customer and have a lot of profit down the road, right? But because it is in the R&D, they can't really capitalize it. They can't really amortize it, right? So what happens is that they just like become expense. So if you deduct it as an expense, so it hurt their current period profitability. So that's why we can see that, okay, if they keep on doing R&D like crazy, right? So the company will be forever losing money. They only lose money because of all these expenses into the R&D. It's not like their business is not making money. So you need to differentiate these two. But with that said, I would say in the recent 1 or 2 years, it's not because they spend too much on R&D, hence they are not making money. It's really because all these fulfillment costs, they spend already, but it cannot get to like 100% utilization. That's why there's a lot of money lost there, and these are real money. That's why their stock price has been so weak. It's really there's something like some wrong move in terms of their strategy. But all this come with a good thing is that because when in doubt, they really focus a lot more in like meeting their customer demand. So they make sure that there's no room for their competitors to squeeze in. So that is why if you look at US or the Western market, there isn't a lot of competitions when it comes to e-commerce. It's because of they know that they have to go against Amazon. They don't want to go against it already because whenever in doubt, Amazon will always overspend. So if they overspend, means that you can't really provide fulfillment capacity that is on par with Amazon. So if you can't compete with Amazon, you don't want to go into it. That's why they kind of like dominant, like they really become very dominant in e-commerce, right? Unlike in China where everyone just like, wow, look at Alibaba. Oh, Alibaba, you are not spending a crazy. So there's room for me to squeeze in. So they squeeze in. So what happens is there's a lot more competitions there. So I think that's some difference when you study the dynamics of different markets. Anything to add here? Is misallocations of venture capital one of the leading causes of hyperinflation? Is Mr. Typical Singaporean, are you here? Well, only Maximus here. I saw these debates in the chat group. I think that's quite interesting. I can see the point from Mr. Typical Singaporean where he said that, okay, because there's all this venture capital, they raise money and then they tend to, when they raise money and then they all this money channeled to specific areas. Say, for example, they channel into like all this software and so on. So that there's money chasing all this capital chasing all these specific areas, say, for example, like AI and so on, right? That cause not enough money flow into oil refinery and so on. So it caused certain, under investment in certain areas, and all these areas, say for example like chip manufacturing and energy, and that leads to hyperinflation. I would say this one, right, is very hard to explain because all these cause and effects, right, is like a giant web of dependency here. I would say that maybe yes, there's some truth in that, but definitely it is not the only reason. And I will argue it is not the dominant reasons, because the dominant reason might be something to do with COVID, and then COVID plus all this underinvestment in energy, which got nothing to do with VC, got nothing to do with COVID. The underinvestment in oil has been ongoing for a number of years. You can track it like more than 5 years. So I will say that all these things, some of these like factors, right? They are there for a number of years, but they stay hidden. People didn't realize it. But suddenly when it explodes, right, it becomes like a big issue, and there's some of these are like one depending on the other. So a lot of things like jumble up together that cause all this inflation. I'll call it high inflation. So don't call it hyperinflation. Hyperinflation is a situation when you have like inflation of like 10% per month. That one is hyperinflation. In our current situations where you have like between 10 to 10, even 12%, this is still considered high inflation and not hyperinflation. But anyway, this is not an easy topic to discuss. I think even among economists, they don't have a consensus. But anyway, understanding this also maybe doesn't help in terms of your investment. So it's good for like intellectual discussions. So it's interesting if you are interested with this topic, but I don't know how it could help. That's why I don't debate so much on this. Maybe one day we can get Typical Singaporean here. Anyone here will please remind him to speak about this topic. Not much comment from me. Next. Has your perception on the legitimacy of Bitcoin or crypto changed, increasing your allocation into Bitcoin or crypto, given what is happening to the banks? I would say for me, my view on Bitcoin and crypto hasn't changed. Has been quite constant throughout past 2 to 3 years. The reason I haven't been buying Bitcoin for some time is just the hustle. Because in the past, I've been using Binance and then using FTX. Then FTX gone down already. I just lazy to see whether I want to buy Bitcoin and go to Binance again, or whether I should open another, crypto exchange. Just the hustle. And also, I think, forget about like all this Bitcoin or crypto, just the traditional finance, although we've been talking about inflation eating your real worth of your fiat money, but when you look at the like all these bank that offer you, let's say like what, 4%, 4.5%, to me, I would just rather put into bank if I don't want to put into equities. So and because of that, I mean, opening account for crypto is not something that I think I will do it now. That's what I've been thinking. In terms of whether it will be viable or not, say for example, like talking back to Bitcoin again, I think their value proposition since the start has been the same. It's like it always come back to, okay, they will help you maintain the real worth of the currency because of the scarcity. So it has been always been that, whereas let's say if you hold some fiat, there's this increase in the M2 money, keep on increasing. So you are kind of like diluted away. So you will feel the effect from the inflations. So that's the fiat, the dangers of holding too much fiat money stuff. But the problem with Bitcoin is that whether they are able to attract more people using it. Because if imagine that, okay, still they are capped at 21 millions. And yes, you hold a lot of all this Bitcoin and you hope that the price will moon. But let's say from now and look forward 5 to 10 years, if the Bitcoin story somehow doesn't grow, like it's actually dwindled down, right? People like listen to Bitcoin story, they're kind of like boring. Like, oh, it has been the same story. I hold it for some number of years. The price still keep on dropping, and people don't like not attracted to this story anymore. And in terms of the so-called the Bitcoin economy doesn't grow, meaning that there's no increasing number of people transacting in Bitcoin or using Bitcoin or store money in Bitcoin. If that happens, right, what it means is that the price of Bitcoin, it will not able to grow just because they are not able to grow people and the entire economy actually shrink, right? That could happen. It doesn't matter. Like 21 million still stay 21 million. If nobody using it, the value will just drop. That's the fact. If you invest in crypto, you can understand what's the the narrative, and then just make an informed view on whether this is something a story that you want to bet on. If it is not, then go to something else. I mean, even equities also, there's some story behind it, right? Like why are you holding, let's say S&P 500? Why are you holding S&P 500? You need to understand the selling point, right? And why are you holding? Like, are you holding it S&P 500 because it has been working in the past 100 years? Yes or no? Maybe no, right? Maybe yes. I don't know. You have your own story, basically. But for me, I would say S&P 500 is a story of like, okay, US will still be dominant in the next 20 years. And you're holding all these business are still well managed, and the price isn't like overvalued. And on average, S&P 500, how much is their return, ROIC, and so on? You can look at all these, try to see them as a business and ask yourself whether you want to own this business or not. And if you own Chinese stock, I think it's the same argument, right? So what are the selling point? It could be that as simple as, okay, these are the business, and this business are still churning up profit. I want to own this business. And in terms of GDP, China GDP of total global GDP is like such a big percentage, but when it comes to market cap, they're so small. So it doesn't make sense. You believe that there will be money flowing into China stock market eventually, so you want to own it now. So this is some story to justify owning a lot more Chinese stocks in your portfolio. But again, it comes back to number one is to understand the story. Number two is that asking yourself want to bet on the story or not. Number three is just track over time whether this story is playing out or not. Because if it is not playing out, you might want to revisit your thesis and see whether you want to go again. Like try to continue to betting on it or not. For any asset class is to understand what is your story behind that and come up with your own story. Don't just listen to other people's story. It's easier to convince yourself to continue to holding on the investment if the story is something that align with what you have in your mind. If your story come from someone else, then what you can resolve to is just blame the other person, which is not a good idea. Anything to add from anyone here? Okay. Legitimacy refers to one, dollar governed by rules and not rulers. 2, real-time data and solving the latency problem. The Fed is operating with their data. 3, disintermediation. Okay, I need to look at the list. I wonder who would pose this question, but I think these questions come back to something to do with Fed and so on. And the only person who can answer this in details that I know from the group is YCX. He's not here. I can't answer this, man. I'll give this a pass. I think this, I would say that whoever posting these questions, I'll say thanks for the questions. Good question here and good arguments. I think this is talking about like the monetary, the mechanism of how money is operating, right? So I think this is good point here. But for me, a bit hard is that I think each of these point, right, number 1, number 2, number 3, each of these point is a big topic of themselves. So it is a big topic. It's not so easy to tackle them. The other thing is that there's no question here, so I also don't know what to comment here, right? So again, good pointers. Hard for me to comment. not my area of expertise also. Next one, from your ROIC video, agree better to buy high ROE company. The problem is high ROE can turn into low ROE and you can lose a lot. How to tell high ROE can sustain? Not sustain. Okay. This one, just before we click the record button, Boon and I was just joking around like, okay, how to answer these questions, right? Because if you can identify one company with very high ROE or ROIC or whatever, if you can identify that company and you know for sure this company can maintain the ROI or ROIC for like, let's say 10 years, right? I think you can just all in and just hold for 10 years. I can assure you 100% you earn money, a lot of money. But the point is that two requirements. One is that it need to be high ROE. High means high isn't like 10%, high is like what, 20, 25, 30% or above. This is considered higher, at least 20%. Okay. Number 2, which is the harder than to identify the 20%, is that it need to sustain for 5-10 years. This one very, very hard because there are companies, they sometimes, if you track their ROIC, right, it goes up to 20%, 25%, even 30%. Then you just stay there for 2 years and then come back down to 15, 10%, right? So this one doesn't count, right? Because once you fall back down to 15, 10%, the share price also down. So you can't really like get a high returns. So there are 2 requirements. One is high. Number 2 is long, can sustain for very long. But the very difficult thing is that how to tell. Like you can on surface, you can study a lot, look at the business is good. Yes, it can stay good for 2 years, then just going down, right? Who can tell, right? So very, very hard, I would say. Even good investor, those who able to invest in good company that generate good returns, and with hindsight, you can see that their business is able to generate what, 20, 30%, right? But before it happens, right, who can tell, right? Even Buffett, they have investment that they thought is a good investment, and then it turned out that isn't so, right? So I would say that when you identify, you can study the mode and so on. You can bet 5 companies, and you have to be comfortable to know that, okay, out of these 5 companies, yes, some of them, maybe 2 out of 5, you can generate like what, 20, 30% ROIC and give you a good returns, but you can never be like find a recipe to guarantee you that one specific company that you study can help you generate what, 30% ROIC, right? I don't think that's like you shouldn't have that kind of expectations because investment isn't that easy and when you set a high bar to say, okay, my bar is that I want to identify companies can generate 25% ROIC, can stay there for 5 to 10 years. I think this is a very high bar. I don't think that is that easy. I can tell you that I don't know how to do that. Just be frank. But to me, not able to identify such company doesn't mean that I don't invest, right? Because like you study S&P 500, they can generate like 10% over the past 20 years. What it means is that on average, this business can generate, like between 8 to 12% ROI or ROIC, doesn't really matter. So to me, 10% is good enough. So I'm comfortable investing in that. So, but talking about like, am I such a good stock picker that I can generate 20% ROIC? My answer is no. I know things that I can do and things that I cannot do. If cannot do, just accept the fact. No. So, but again, the point of that video is not saying that, oh, ROIC important, I know how to generate 30% ROIC and my return will be 30% ROIC. That's not the point of the video. The point of the video is to say that if you invest buying cheap, how you return from buying cheap is that the valuation of that specific company revert from cheap to less cheap. So if that happens, you can lock in the gain and then you move to another companies. So that's how you profit from buying cheap companies. And if you invest in high quality business, which is companies that you believe they can generate good ROIC, you don't need to buy low, sell high. You just buy and hold. And because the business itself can generate, like let's say 15% ROIC, over time, your return from owning the stocks, right, will be 15% ROIC. And with that, you can just buy to a single company and just hold on and just track whether they continue to generate that kind of ROIC. If yes, you can hold on to single company for 10 years, 15 years, 20 years, your return will be good. But the thing is that the risk that you're running is that, oh, I thought it is a 15% ROIC, then like 3 years down the road, suddenly become 5%. Oh, what to do now? So this is the risk that you're taking, right? I can't guarantee you that a company that generate 20% ROIC now can continue to generate it. So yes, I agree with this statement that the questions of how to tell, there's no easy answer. Okay, anyway, that one was a long video. Thanks for watching. Yeah, and thanks for these questions. Next one, Buffett says buy company with good CEO. How to tell good CEO who is present day is like Tom Murphy of his day? How to tell or where to find out? Boon Song, you want to comment on this? Is Boon Song there?
Usually, right, you want to see whether they buy stock.
Buy share buyback or what?
They buy stock using their own money. Share buyback, anybody can do. Any company can do. Is whether they eat their own cooking. Because most of the time we talk about people like Tom Murphy, I don't think he was the founder, right? He's not a founder operator.
No, he's not.
He's not, right? Yeah. So he's a guy who came from outside and was appointed as CEO, and he eats his own cooking. That's one clear sign. Then obviously, when it comes to quantitative measures, you look at ROE. Tom Murphy is probably the story whereby people are attracted to him because he managed to operate a small ship and beat the giants in his industry.
Yes.
Yeah. So it's pretty much a look at the ROE numbers over the years. Because I'm a numbers guy, so that's the only answer that I can offer you. Whereas looking at the human qualities of the management, that is something that you and I probably would find it difficult to access and assess. You see, that's my take.
Yeah, agree, 100%. I think Tom Murphy, I haven't read in details what his story, but from a couple of articles, I know that he's famous for like his management. It's not so much about on his investment. So when he managed the business, he really like cut the cost. I recall there's the one that from the book, the Disney book, Bob Iger's book, he mentioned about ABC, right? Some, and then Tom Murphy. I think there's some story on that. I can't recall the exact details. But what happened is that when Tom Murphy, he like bought over a business, and then he just do like crazy like cost cutting and so on. So it's really like you want, let's say if you have a manager that helping you manage your business, you want to find a manager like Tom Murphy. Is that he don't build empire. He's more like, okay, I just manage. Just a very honest way to manage and then know where to cut costs and so on. I think yes, this is the management philosophy and not just like the personality lah. So I think that's one. And second thing is I think when it comes to business also, like there's all this like share buyback because the business operating at a very high ROE, you have all this excess saving and you buy back your own shares, and you don't simply buy back at any time. You buy back when the share price is very low, and then that also added up the returns to the shareholders. So I think a lot of things that's like you look at it from a capital allocation perspective and look at it from like a day-to-day business management perspective. You can I think again, this is like with hindsight, you can see the result and you can see what are the things done right. So it becomes a good story to tell. But again, from let's say if these things haven't happened, you just study a specific manager and just look at a couple of actions and you want to say, okay, how to tell whether good or bad. This is the qualitative part of the assessment, which I agree with Boon Song, is that it's very hard to look and hard to assess from the outside. Because if you look at a manager that keep on cutting costs, and yes, you can see the expenses keep dropping, actually you don't know whether they are cutting all this fat and cutting all these expenses that doesn't affect their business, or actually they are cutting stuff that hurt their business. So very hard to tell from the outside. From the inside, I would say if you work with a company and you work with the, let's say like the finance department, or the strategic department, you can tell whether specific expense cut or specific expenses, whether it help with the business or not. This one you can tell. But from the outside, when what we see is like a total expenses and total trend of the expenses, whether it go up or down, right? Very hard to assess whether they are adding benefits or actually they are killing the companies. Very hard. Like for Amazon case, right, you can see that expenses, I don't think that expenses is going down over time, right? So even during Bezos' time also, you won't say, oh, Bezos is very bad, because you see he's not acting like Tom Murphy. The expenses keep going up. But after like running the business for 10 or 20 years, you can see that, oh, he really built a giant business. And even Buffett also say that Bezos is a good manager. But you look at expenses, you can't tell. But I'm sure that there are business that, say for example, during Intel time, I think they also didn't spend a lot of money in terms of their R&D, which resulted that TSMC now eating all their cake, right? So for example, like in the past, Apple has been using Intel, and I think when Apple they want to design their iPhone chip, also they have been talking with Intel. But why Intel isn't in the smartphone business? That's the question, right? It's because if they are dominant in PC market, and if they want to design, move into smartphone market, it's not just like, okay, straight away you have revenue, right? You still need to spend in R&D and so on to steer away your business to focus more on smartphone chip. All this require a lot of R&D, requires spending. And if you don't do all this spending, meaning that you just look at it from a cost perspective, sometimes from the outside, you thought that, oh, you see the expenses didn't go up or looks good. But actually, in the end, they didn't spend in necessary things, which turned out bad. So I think there's a lot of story that with hindsight, you can tell whether they did the right thing or wrong thing. But if you're just looking at it on a real-time basis, it's very hard to tell whether it's good or bad. So again, investment is not easy. If it is easy, everyone is already like rich, right? So that's why very hard now. How to know Facebook and Instagram, how many hours their user use daily or something about usage? They only tell about number of accounts, which is useless actually. I will disagree on the second one that talk about like number of accounts, which is useless actually. I think this one is the disclosure given by the management. At least you get to know whether the number of their monthly active user, whether increase or decreasing. Because if it keep on decreasing, for sure the business is going down. So I think this is something that the management disclose, and this is the minimum thing that you have to track. Okay, if you invest with the company. Okay, that's on the monthly active user, the daily active user, and so on. Then the other thing that company disclose, which is their revenue. I mean, as simple as revenue, right? They disclose their revenue, at least you track the revenue to tell like, okay, how, aside from the monthly active user, and monthly active user multiplied by numbers of hours the user spend on the platform, and multiply by how much, for example, the advertising revenue that the companies take in. All this actually translate to the revenue of advertising. Okay, you don't know the middle part, which is like how many hours the user spend. At least you know the end part. It's like number of users times number of time spent times the monetization equals to the revenue, right? At least you can see the revenue, which is the they disclose, right? This one you also can track. So although you are missing the middle part, at least you get to know the ending part, right? So at least there's some metrics that you can track. Then in terms of how many hours the users spend, I think this one is not disclosed by the management, but at least in terms of like, there's some survey done. These are usually done on those who do like market survey. They can survey users and ask them how many hours you spend on TikTok, Facebook, Instagram. And then once they have enough data, they can plot some chart to show you that, okay, ByteDance, when it comes to TikTok, how many hours people spend, and versus IG, how many hours spent. At least that one, I won't say that one is definite, because that one is not the entire data set. That one is like based on survey. But at least from the survey, you can get a sense of how many hours time spent. Give that one, treat that one as like a data point rather than like something that can you can act on it just based on that metrics, right? But at least that help you have a sense on like how all these like social media, how good are they in terms of like retaining the customer eyeballs just because of how their product works. So I think it's still useful. If you get all this data, you can take this as a data point to assess whether this platform will still be going strong over the next couple of years, or is it because like too much nonsense that even yourself don't use the platform anymore. So I think you do your assessment yourself. It's just that I don't think like don't say like, oh, this data point is useless. I would say that take this as a data point, take the revenue as the data point, take all these survey data as a data point, and once you have all these data point, you merge together, then you form your assessment. I wouldn't say like good or bad. I would just say that, yeah, take all this as different data point. How's the job market situation in Singapore now compared to 2022? Are you seeing more retrenchment ahead in 2023? Wow, this one very hard. I'm not in the HR department. I would just say that, let's say over the past 1 year, I think the job market was considered quite hot. As of now, even I think US or global job market is still doing okay. I think the part that is not doing okay is like really those tech related sector. So because I think tech related sector, maybe they get too much funding at one point, they have too much money, they hire too many people. Now suddenly everyone following maybe Mark Zuckerberg league, everyone want to be in, operating in efficiency mode now. That's why there's a lot of layoff in tech industry. But at least based on like surface view, right? It's really like affecting like tech industry. Overall, I think like overall job market is still doing okay. So anyone who plan to change job, I think maybe now is the time. But if you are changing job now, what it means is that if we get into recession and you get retrenched, then you also don't get too much all this severance package because you are just like, less than 1 year with the company. There's a lot of risk taking there as well. But in terms of the job, like inflation, wage inflation, I think it's still we are still seeing inflation and wage growth. So I think, yeah, if you stuck with your company for too long, I think the fact is that it's very hard to you to ask for inflation, for the increment. You still get some increment because inflation is high, but it will never be enough to cover the actual inflation one. You need to hope job to get a higher increment. I think that's just the fact, right? Let's just stop here. This question is more on like job market situation in Singapore. I don't have a particular insight on this now. Anyone, Jun Boon, you want to add on this?
No comment. I stick with the same job for 20 over years.
Why no plan to change job?
A mixture of good colleagues and lack of ambition.
So your colleagues also stay for very long now?
Yeah. Most of us in NTU stay for very long.
Have you
the same kind of DNA?
Have you like interviewed with other companies before?
Yeah.
So
but in the end, I still decided to stay.
Have they offered you have they offered you?
Yeah, got.
If you don't mind, can you share like in terms of percentage, right? What's the increment? Like
the thing is not much not much.
Okay.
Not much. That's why I jump.
Say for example, if they offer, let's say like 10%, I don't think it makes sense to make a move, right?
Yes.
So it's just too little. But if you interview, let's say there's some good prospects. Let's say if they offer you like 30%, right? Would you make a move?
Of course.
Yeah. So
because
I think
promotion is not certain.
Yes.
Promotion is not certain though. That's the only way you can get increment here.
I think, right, this one, a job tip for anyone listening, right? If you stay with the same company be it like 20 years or even just like 3 or 5 years, right? And if your hope is that you just want to get the promotion, and with promotion you get higher increment, my kind of like suggestion to you is that don't bet for the promotion, because it's a lot harder for company to promote someone within versus they hire someone from outside. Say for example, there's this things, right? Say for example, you have like 3 or 4 colleagues or 5 colleagues working around the same level, and now the boss just left. And out of these 5 people, yes, there might be some seniority among 5 people. And let's say they are not too different. And let's say there are some people who like, stand out versus the other, right? Actually, even if you stand out compared to your peers, companies is a lot harder for them to promote, because what happened is that, let's say out of these 5 people, the one that stand out, the one that the company want to promote, now they become the boss of their friend. And it's a lot harder for you to manage your peers when you guys are just like peers, like just before the promotion. So they are peers, right? Like people, we are all like equal. Now suddenly I become your boss, I need to manage you. It's a lot harder compared to, let's say, if they just hired someone from the outside, and this outside people, like all 5 of you don't know anyone, don't know that person, right? And if it come in, there's no like this kind of like relationship before this, so he can come in and just become your boss, because there's lack of all this relationship. So usually company, they will prefer to hire someone from the outside to become the boss and manage the team, rather than promote from within, because promote from within, they have a lot of all these issues, very hard to manage peers. And then if you have situation where there are 2 people who stand up, and these 2 people, they kind of like expecting a promotion, and the company can only promote 1 person to take to handle the team. So if you promote person A, person B will just leave, right? Because walao, I thought I will be promoted. Now you promote the other guy. Am I not as good? So he will leave. And you promote person B, then person A will leave. So how to keep 2 person if you think these 2 person are equally bright? So you just get someone from outside to manage both of these 2 person. No? So I think this is the some of like hard truth of like the job market, whereby it's a lot easier to hire from outside. So if you understand this dynamics, right, what it means is that if you think you have good qualification and you are good in terms of your work, you should actually be the one that get hired from someone else to go and manage the other people team. you want to be the person F that get invited to manage this small team here, rather than the other way around, rather be person A or B. So that's why I'll say that it's a lot easier to get a promotion if you just hop to the other companies, rather than just be loyal and stay on with the current companies. You need to think from the company's perspective, and you think it actually makes sense to hire from outside. I know whenever companies hire from outside, people from within, they will complain. Wow, just why do aren't we have good people? We also have good people. Why go and hire people from outside, right? But if you look at it from a company perspective, you will understand it actually makes sense to hire people from outside for many reasons now. And for example, another reason is that, say for example, this role, right, is a managerial role. Managerial role, let's say their pay, right, let's say it's higher, let's say it's 10,000, but the person A to B, their salary is 5,000. Okay, so again, the manager just left, they want to promote from within. Actually, it's a lot harder to promote person A, and the salary just from 5,000 suddenly become 10,000 or become even 8,000 also. It's very hard one. It's not like that one. It's not like, wow, suddenly you become manager, now you deserve 8,000, then you get a 60% increment. It doesn't happen like that one. If you get promoted, you can get like what, 20% increment, maybe 30. That's the max already. You talk to HR, there won't be anyone, they won't tell you that, oh, promotion easily, that role is really 10,000 role. We can just give you 100% increment. It doesn't happen like that. But if they hire people from outside, then it's a lot easier for them to like justify a higher salary. And from department's perspective also, if you are the department head, you also don't want to lower down the budget for your department by replacing 10,000 workers with like promote from within now become 8,000. You also don't want that to happen. You want to maintain the budgets, right? So what happened is that, okay, if 10,000 salary person left, I just hire from outside, at least to maintain, right? That's why it's very hard on for your own, let's say, career progress. It's a lot easy to like just hop around. And when you hop around, it's not like just first offer come in and you just move around, right? You can also just ask around, make sure that there's a good career path, make sure that you are getting a good increment by jumping. Because when you jump, you go through all sorts of like discomfort of need to know new groups of colleagues, need to understand new culture, need to blend in, a lot of like all these things, which is very uncomfortable. But once you go through it, you expect some, some increment, higher responsibility, better roles, and so on. So all this come in a good package that you think that, okay, good enough, then you just make the move. Then that's good for your career path now. I think this is very true for those who, let's say, work for between, let's say, 5, even 10 years or even 15 years. As long as you still move around, seek for a package that work well for you. Maybe you can talk to your friends who move around, and then they can share like those tangible examples. Then at least while the market is still good, this is the time to move around. You want to, during recessions, there's just no job opening, how to move around, right? At least that's the opportunity. Okay, I'll stop here for today's. Thanks a lot for joining. Enjoy your lunch.